Hi, welcome back to The Lens with Craig Shapiro, Larry McDonald here. Thanks for joining us. This is a weekly program where we recap our institutional chat. All that means is we work with some of the largest institutional investors, the hedge funds, the pension funds around the world in more than 20 countries. And we want to recap kind of the intelligence gathering from this week, once a week on Fridays with Craig Shapiro, who runs our Discord room. You got to get involved. Tatiana at thebeartrapsupport.com. Tatiana at thebeartrapsupport.com. Get involved. Join us in the Discord room. We're democratizing information. It's a revolutionary platform where we're bringing kind of that conversation of the institutional intelligence gathering into the Discord room. Say you're coming off an airplane. Say you've been in a long, boring meeting, and markets are moving, risk is moving. You come into the Discord, you get engaged with Craig and the team, and you get an incredible download as to what's happening. Where's your portfolio? Join us. Okay, let's hope. Join us this week. Craig, walk us through, your intelligence gathering this week. You're working with all the funds. What are clients talking about? I noticed one thing I keep hearing like the last several days is, this massaging of interest rates below the rate of inflation. At the end of the day, consumption and GDP, the top 10% of consumers are 60% of consumption. The top 10% of consumers are 60% of consumption. And that's because we've had such an inequality explosion. And the only way to kill inflation is to really slow down that top 10%. Because if not, the bottom 60% are being really hammered by inflation. That had a big impact on the election. And I think at the end of the day, the Trump team is trying to get rates down, interest on the debt over $1 trillion. If they can get interest rates down, what was the stat that you came up with, Craig? If they get rates 100 basis points lower, it'll save $400 billion in interest costs next year.
Yeah, I mean, there's pro-cyclical reasons why it's important to bring inflation down for this administration. Obviously, you mentioned just how they got elected, how the lower end consumer continues to be hampered by high inflation, high prices, high interest rates, credit card rates, auto loan rates, everything. And so there's it's a paramount importance to the Trump administration to bring down prices and to bring down inflation. That will help cut the deficit, as you mentioned, from lower interest costs, but also there are cost of living adjustments in the entitlement spending programs that will come down over time if inflation is lower. So that can help reduce the deficit growth as well. And so Bessent has really tried to orchestrate this idea that if you bring down inflation, that'll bring down deficits, that'll bring down interest
Craig,
rates.
what's the message here? Trump is trying to create a recession as far away from the midterms as possible?
Yeah, I think we've been talking about that for a while. If they can move through some of this transition of the public sector to private sector, obviously the Biden administration really pumped up the public sector growth, employment growth, and the federal government, really exploded during the administration. And so the idea here is to blame the prior administration for the inflation, for higher interest rates, and for a bloated government sector, and transition us to a more sustainable, healthier private economy over time, right? Aided by deregulation,
Craig, Musk and Trump looked us straight in the eye this week, and they said, "Listen, we're spending $7 trillion a year.
We're going to go bankrupt if not."
But yeah, we're going to go bankrupt at $7 trillion. But we're going to take it from 7 to 6 in a year. There's no way you do that without a very.
Look, I mean, obviously, both Trump and Elon are known for hyperbole, but look, I mean, you're taking they're trying to take a very big chunk out of government spending. The government is close to 25% of GDP. So if we're going to try to drop government spending by $1 trillion on $7 trillion, that's 15%. On 25% of the economy, you're talking about a 300 to 400 basis point hit on GDP, right? So the rest of the private sector would have to make up an extraordinary amount of growth in order to balance out that without a recession. And so basically it's impossible, right? We have to have a pretty sizable growth slowdown here in the near term, and then can rebuild the economy in the way that these guys see fit, with a smaller government sector, with a more sustainable supply chain, with lower energy prices, and with deregulation. And so that's the long-term plan. But to get there, we have some short-term pain. And Trump has been pretty adamant throughout the last several months. He's said short-term pain for long-term gain various times. The market hasn't really believed him up until about 7 to 10 days ago. I think they're starting to believe him. And this week, we started to see that in the equity market.
So Craig, yeah, well, let's talk. Where's the trade for investors? So one of the things we talk about in our book, When Markets Speak, bestseller. Look at the trade this week. Well, where's the trade? So what we just had up was a chart. And what I've noticed is industrials, which is the VIS ETF, are now dramatically outperforming the Qs over the last 2 years, 3 years, 4 years. That's unusual. The last 10 years in that disinflationary regime, you've had very consistent underperformance in the Dow. And then if you look at value versus growth, Berkshire destroying the Qs, all the big value ETFs are destroying the Qs. So in a growth environment where GDP is ripping and the yield curve steepening, right, in that kind of world, that's where people want to be overweight growth. But if they're trying to engineer a recession and you get in more of a stagflationary world, in that world, value is going to outperform growth, and that's what we've seen, that big move in value this week versus growth. What have you been hearing?
Yeah, I think that's where we're seeing it in a bunch of the charts we have. We have a consumer staples chart versus the Qs, and we also have the breakdown in semiconductors versus the S&P. And so you're really starting to see that rotation under the hood. I mean, people have been talking about the AI story and the AI productivity boom for quite some time, but it appears. I mean, Nvidia has peaked out in July, and semis peaked out on a relative basis versus the S&P in the third quarter of last year. So even though people are talking about how great AI is and will be, the markets are speaking, right? The markets have been transitioning now for the last 2 quarters away from that on a relative basis. And so, look, everything's had been going up, but these other sectors have been catching up and been moving up in a larger way.
And that chart, bring back that last chart. So the staples, we have a model that measures the rate of change in the staples versus discretionary, in the transports versus the S&P, and bond yields, and if the curve's steepening or flattening. A flattening curve along with this is a signal. When you see staples, you're talking about Colgate, you're talking about Coca-Cola, recession-proof stocks, outperforming the Qs, outperforming growth. That and it's on a very sharp rate of change. When you see that historically, this is the type of thing you saw before Lehman, before COVID. We're not saying this is a Lehman or COVID situation, but these are the type of things that you saw. Transports dramatically underperforming, bond yields coming down hard, staples outperforming the Qs. This is unusual behavior in the markets. Markets are speaking, and there's a big message right here.
Yeah, I think maybe it's culminating with this Atlanta Fed now GDP estimate that came out this morning is showing a very protracted slowdown now for the first quarter, looking for negative 1.5% GDP in the first quarter. Now, a lot of that has to do with the export numbers. The import numbers from last quarter. The U.S. trade deficit hitting a multi-generational high in December as we had massive front running of goods ordering ahead of the tariffs, and so you'd expect a pretty sizable give back in the first quarter. There's also a fall in real personal consumption expenditures, and so a growth slowdown is becoming top of mind. And the markets are suggesting that with the outperformance of value versus growth, with the outperformance of staples versus the S&P. And so markets are speaking ahead of the data, right? And so if you kind of look at the internals of the market, you could have anticipated that this growth slowdown was coming. And you marry that with what the Trump administration is talking about with respect to deficit spending reductions and bringing down inflation. It all kind of meshes here to a very choppy to downward trading environment now for equities, and a large strong move in the bond market over the course of the last 4 to 6 weeks.
Yeah. So let's look forward. So what's really happening? A secular change is in the works where your top sexy sector, the sector that every analyst was upgrading all summer, is now rolling over versus the S&P, because that sector, growth stocks, semiconductor, are really built for that kind of growth, high GDP growth economy. If you move into a more stagflationary environment, we're looking at things like we have a special report. I mean, this is a report you have to get your hands on. It's on the copper and the next 10 years, next 2-year trade. Tatiana at the beartrapsreport.com. Think of the Ukraine rebuild. Okay. In the report, we go through the Ukraine rebuild, we go through the Gaza rebuild, we go through the LA rebuild. And then Craig and Robert did some incredible work on data centers. How much copper? $2 trillion of CapEx has gone into data centers. And that's a trajectory of the last couple of years, also looking forward. $2 trillion bucks. And the valuable commodity for data centers is copper. And the most valuable commodity for robotics is copper. And so you've got a US power grid in the United States that's 30 years old in some spots, 40 years old in others. It's a $2 trillion rebuild. We can't put a Ferrari on an old railroad track. Like we can't put, I mean, this is insanity. The entire street has spent the last year upgrading all these AI stocks. If you look at copper names, Tech Resources, way off the highs, 30% off the highs. The COPX, get our report, Tatiana at thebeartrapsreport.com. Craig, in closing, kind of recapping the week, what are clients talking about? Like, where's the trade? Are clients putting on shorts? I know we're moving more from growth to value, but where's the trade? What are clients looking at? That move overseas, right? That's another.
Yeah, I think we've been seeing that transition from growth to value, as you mentioned, and into hard assets. We've also been seeing a move into Chinese equities and more European equities as this U.S. exceptionalism trade has come under a bit of pressure. But broadly speaking, I think people are concerned here for the next 4 to 6 weeks. We've seen a pretty good sell-off, this week. In many names, the overall indices have outperformed, but many names down 20, 30%. Some of the high-flying names have really gotten, high retail sentiment names have really gotten shellacked this week. So I think a lot of institutions are playing a little bit closer to the vest here, concerned that the Fed is really not in a position to add liquidity anytime soon here because of the sticky inflation. So even if we keep getting bad growth data, the Fed's not going to come to their rescue, and that it's become part of the administration's agenda to slow down the economy. So you're not going to get the Trump put activated right here. And so clients are thinking about hedges and thinking about, being mindful of how they transition their portfolios for the rest of the year. But right now, caution seems to be top of mind.
And then one of the clients sent this chart to us. You could pull that chart back up about the financials. And one of the conversations point in the chart in the chat this week in our Discord room was around the financials and this ominous kind of underperformance of the tertiary financials. If you could put that chart back up. So subprime lenders like Affirm, Sophie, Synchrony, so that's SYF. Those three companies are more in that tertiary financials. They're the second, third tier companies. The XLF is filled with big, absolute giant financial companies. But over the years, when you see the tertiary financials underperforming, and it's a very sharp rate of change, that typically means something. And if you, like I said, if you line that up with the move in bonds, you line that up with the move down in the transports, you line that up with the staples versus discretionary, markets are speaking. How to listen when markets speak, pick it up on Amazon. But Craig, this is the point you were just making, is that if the tertiary financials are slowing down versus the big financials at that rate of change, it's a sign that the speculative froth in the market that was betting on kind of growth economy with subprime lending being okay, that's shifting. And we saw the same thing. Triple C's are starting to widen out versus triple B's this week.
Yeah, I think what the Trump euphoria is turning into Trump uncertainty, right? I mean, he was elected on a mandate of bringing down inflation, deregulation, supply side reform, things that really benefited a lot of these smaller banking institutions and will benefit the economy over time. But right now we're in an uncertain environment, uncertainty about the tariffs, uncertainty about the budget, uncertainty about immigration. And so companies are sitting on their hands a little bit more on hiring, on CapEx, and consumers now are getting a little bit more concerned about job security, certainly layoffs in the government sector. And so both those things combined are making people a little bit more cautious. And so we have to get through that uncertainty period. And then once we learn about what the tariff regime is going to look like specifically, and what the budget process and tax cuts are going to look like, it's very likely that this economy will come back. Folks want to invest. Folks feel comfortable about the long-term prosperity of the U.S. manufacturing renaissance that's coming back and the AI infrastructure build out. But we got to get through the uncertainty period first.
And Craig, in closing, tell people about the One Idea. So Craig and I have a new product. It's called the One Idea. Craig's kind of running the show. And once again, we're trying to democratize information at a lower price point. We're going through, Craig, what's the objective? You have one idea from all the intelligence gathering for the week and sharing that with a large audience.
Yeah, certainly. We're having hundreds of conversations with clients throughout the week around the world. We're publishing that on a daily basis in our overnight reports. We have a weekly report called The Turning Point, which kind of summarizes all that. And what the One Idea does, it tries to take the best or one of the most topical pieces of information that we've gleaned through the week and really unpack it, flesh it out, and put it in an easy to read format with, sometimes with a tradable idea. For folks, last week we talked a little bit about copper. A couple of weeks ago, we talked about this K-shaped economy and some of the internals of the market.
Nice move in the VIX.
VIX. So we've been trying to be topical and be mindful that folks want to see the information, but they also want to understand how they could potentially make money with an idea. And so I think that's what this product is trying to accomplish.
And if you could bring up the Nvidia. So one of the things we do is we trade around. You got to have skin in the game. Wall Street research is fiction without skin in the game. Wall Street research is fiction without skin in the game. These guys are dangerous, these analysts. They sit at the same country clubs. It's all groupthink, and they will hurt you when the market turns. Nvidia is a perfect example. There's not one sell on Nvidia. The street's price target on Nvidia is now almost $60, $70 higher than the stock price. And that's because every analyst on the street is cozy, kissing ass to the management team at Nvidia, has a cozy relationship. And when that happens, there's skewed interest, and it's very dangerous for investors. One of the things that we do from time to time is put out trade alerts, hedges. We've been trading around the Nvidia. We're still short on half the position. We just sold this morning a quarter. And what we're doing there is we're trying to get out in front of this kind of secular shift within the market around CapEx. The CapEx trajectory is enormous for artificial intelligence, but there's a lot of stresses there on companies in the valley that may not be able to keep up this pace. And if that's the case, companies like Nvidia are going to get hurt. But to get on our trade alerts, it's Tatiana@thebeartrapsreport.com, Tatiana@thebeartrapsreport.com. Craig, great to see you. We appreciate you, and we'll catch you next week.
Sounds good. Thanks.